G'day. Welcome to the AgriCoach podcast for families on the land who want to grow their family's wealth and prosperity across the generations. I'm your host, Ben Law, and I'm the Financial Bloke. You've probably noticed that we've had a bit of a change on the podcast from the Financial Bloke podcast to the AgriCoach podcast, brought to you by the Financial Bloke. It's the exact same host, me, the exact same content, and the exact same objective. It's just a simple name change, nothing more. So now that we've sorted that out, let's get cracking. G'day everyone, welcome back to the Wealth and Wisdom podcast. In 2023, many beef producers faced a year they'd rather forget, with steep interest rate hikes, inflation driving up input costs, and plummeting beef prices. To top it all off, many were suffering from a prolonged dry spell across many parts of the country. In many ways, it was a perfect storm for producers, making the latter half of the year particularly challenging. Today, we're joined by Matt Dalgleish, a self-confessed data, chart and market nerd, to give us a take on what he thinks happened with beef prices, what's happening now, and a sneak peek into what he thinks might be in store in the future. Matt brings a wealth of expertise as an agricultural market analyst specialising in livestock, grain and wool, with a background in economics and finance, coupled with experience in foreign exchange trading, risk management, education and finally, real estate. Matt offers a unique perspective on all market dynamics. He's a former pig farmer and co-host of the Ag Watchers podcast. He's also the owner of Episode 3 Consulting Group, and he's deeply invested in the agricultural numbers. As you all know, I'm as driven as hell to help as many families on the land as I can, and I can only do that if people know about the podcast. If you appreciate and enjoy what we do and you want to help us out, the best way to do that is head on to Apple Podcasts or Spotify and leave a review. Reviews help us promote the podcast to a wider audience and, as a consequence, to more families on the land. But it also puts a massive smile on my face. So without further delay, welcome Matt.
Thanks for having me, Ben.
My pleasure, mate. It's great to have you here. So, mate, you're a self-confessed markets and chart nerd, aren't you? So why are you into studying the markets and how did you get there?
I am, and it started from an early age, actually. It was the stock market crash of 1987. I'm showing my age here, Ben, as well. I was in year 10 at the time, and that got me interested in what the stock market was. And I invested, some of my hard-earned part-time money from high school. And I did all right at that. I bought News Corp shares and did all right. And that kind of got me intrigued. And then it looked more broadly, other than the fact that you can make some good money, it's just such a fascinating thing, particularly when you look at markets that are nowadays so globally interconnected. And I always liked playing chess as a kid, and that kind of idea of understanding how everything fits together. When something happens in one country, how does that play out in another country? Those types of complex problems always fascinated me. And the bonus is if you can get a good grip of what's going on in the markets. I mean, we're all exposed to them, whether it's a labour market or a housing market or or in equities or other markets. It's part of the modern economy. So the more you know about it, I think the more successful and you can be and the more fun you can have through life, I think.
Yeah, it's interesting, Matt, and I'd love to get your take on this, but I studied economics and finance at uni as well, so I've got a bit of an interest in this, but I don't study it like you do. One thing that I've noticed that's, I suppose, intriguing but also frustrating is markets don't seem to be operating in so many areas efficiently, or they seem to be, distorted or something like that. Are you noticing more noise and distortion and markets acting like you don't think they should? And a prime example of that is the stock market at the moment and the housing market, etc. Are you finding that, mate?
Yeah, it is the case, I think, too. And sometimes it can be policy decisions that can influence that. And also when you go wider than that, even geopolitics, like look at the disruptions we've seen with things like COVID or the war in Ukraine, and then the war in now Israel or Gaza, and how that's flowed through to problems in the Red Sea and logistics, and transport. So I think those type of black swan events that aren't always coming across very commonly, or things that can't be easily predicted, that kind of behavioural stuff. That's what can throw markets out of whack, or when a government does something that's unexpected, like what we see in Argentina when they, put tariffs on their own exports of products or something. So, yeah, there can be issues around market efficiency because of some of these barriers that are put in place that shouldn't necessarily be there, or these black swan events that make life difficult and make it a bit more volatile.
I think it was Ronald Reagan's quote, which is the 9 most frightening words you can ever hear, which is, I'm from the government and I'm here to help.
Isn't that what Kevin Rudd said?
And I think that a whole lot of markets these days are distorted with government intervention, because we've seen far more intervention in every market over the last at least decade than we've probably ever seen before in history, especially not only just in our country, but in an accelerating way, especially in the more authoritarian countries.
Yeah, that's right. There are times historically where you've had what we'd call market failure, when the market doesn't work as it should in terms of, or there's what they call a negative externality, where the market will drive a situation in a certain way that's not what we want as society. But they're very rare, and normally it's the case where it's some other intervention, usually government intervention, that actually causes a disruption and it makes the market not work properly. And they're the ones that are much more common and sometimes take a bit of time to work through to clean up the mess, so to speak.
Yeah, well, it's kicking the can down the road. The intervention doesn't fix a problem. It just usually pushes it out and it becomes worse later. But, mate, that's a whole podcast topic in itself. And today we're here to talk about beef prices or livestock prices. And I think where we want to kick off with is 2023, 2024 financial year, more likely the 23 calendar year, was a pretty shitty year for most producers. And we had rising interest rates, we had inflation growing exponentially, so the cost of inputs were going in. A lot of people were suffering from a real dry time. But more importantly, beef is the one I probably watched the most, but beef prices absolutely tanked for a period of time. Would you suggest, mate, in you watch this market, was it technically a crash, and why did it happen?
Yeah, look, if you look at it from the perspective of the level of price decline, the only other decline of that nature in terms of percentage fall that we'd seen historically that was the same level or slightly greater was the crash we saw in the mid-70s after 1973. That was a significant drop. I think that for young cattle, we saw about a 75% fall in pricing. And this is if you look at, if you inflation adjust the pricing, so you're talking about current dollar values, which is always brings it into line with what happened now, so you can get the right kind of perspective. So 73 saw about a 75% drop in young cattle prices, and in 2023 we saw a 72%. So it was pretty much the same level of fall for young cattle. For heavy cattle, the crash in 73 was a bit worse. That went about 82% down in that period of time, whereas the 2023 one was a 60% drop. But I mean, that's still significant, and at 60% it was probably the biggest drop in the market that we'd seen up until that 70s crash. So I think, yeah, you could call it a crash. The funny thing was, though, that 73, the reason it fell was quite clear economic reasons. We'd lost the market into the UK for beef, and that was our main export market. And then we had a drought, and the country just didn't have the population to chew through the beef, so to speak. So the price just reflected the fact that there was no market diversity. The crash in 2023 really wasn't driven by what I'd describe as kind of traditional market forces. A lot of it was around fear, actually. That's interesting.
Fear-based. So was that the main factor, do you think?
Look, I think obviously we started to see with the rush at turning off cattle. So I think what it was, producers are pretty in tune with what happens with the season and with climate. There wasn't a producer around the country that wasn't aware that we'd had 3 years of really good season, right? 3 years of good rainfall. And a lot of producers are paying much more attention to what's happening with regards to these longer term, what I'd call climatic cycles. So it's not just your standard seasonal weather. It's when you have these changes to ocean temperatures that cause that, what they call the ENSO pattern, or the people might know it as the La Nina or El Nino years, where we go from wet to dry and we have either drought or flood. And that's what we've seen. We had 3 years of a La Nina, which was the wet one. And then most producers that have been looking at this cycle for the last decade or so would know that an El Nino doesn't always, but it usually means dry and can sometimes be extended drought. And I think with the Bureau forecasting that there was a high chance of it moving to that drought pattern, and the fact that we'd had so many good seasons in a row, I just reckon that farmers were already thinking, look, this can't last forever, this good run of seasons. And so I think there were a few that were already pretty nervous about the prospect of a dry. And when the Bureau started talking pretty aggressively about how dry it was going to be, I think they got the market spooked a bit. And then as we started to see, people adjusting their holding of stock, turning off through a time in the year where you don't normally see turn-off happening, which is through the winter, they started turning off early to try and get prepared. And that flooded the processing market a little bit. So they struggled to cope with the volumes. They were still having legacy issues in terms of capacity, both in terms of labour and plant capacity. So the only lever a meat processor can pull if they're too swamped with stock is to drop the price that they're paying. And then once that kind of cycle started of falling pricing, that kind of encouraged more people to offload and panic a bit. And then you get one of those classic kind of market corrections when everyone's kind of rushing at the exits.
A bit like what happened in the 87 stock market crash.
Exactly. Yeah, exactly. It's one of those phenomenon around markets that you do sometimes see that type of they call it, it's either fear or greed are the two things that drive the market up and down, and that panic selling you see in that fear time, it can make a market overextend, which is what I think we saw that through 2023. When you compare the Australian pricing to international benchmarks like in the US, which is a key market we look at, we were so far out of whack. In fact, the discount between the Australian heavy steer and the US equivalent went to the widest point that it ever got to on record through that 2023 episode. And normally you'd see big wide discounts when we're in the middle of a drought, and we weren't anywhere near a drought. And in fact, the Bureau ended up overstating how dry it was going to be, and we ended up with a pretty wet January in a lot of areas. Not everywhere, of course. There were some places that were still dry, but most of the country ended up fairly wet actually through January, which was very uncharacteristic. But yeah, the discounts absolutely didn't reflect what was happening on the ground. And obviously the market corrected through December, January, February in response to the fact that dry didn't come.
That's interesting. So has that ever happened before, to your knowledge, Matt, where because like you mentioned before with the 70 correction, you saw the UK market get pulled, like a widespread drought. It makes sense. Mm-hmm. If the factors around this were more market hysteria, I suppose, would be almost, or a negative feedback loop is probably the better way to put it. Is that ever, to your knowledge, happened before?
No, usually it has kind of coincided with on the ground factors that are influencing the decision. But what I think is the case too, and it's a bit of a curious one, but I suspect that with some of this added kind of volatility we've seen around things like climate and weather patterns, that I think farmers are becoming much more responsive, and they're actually being told to be, right? So what the farmers were doing in preparation for an expected dry period was the right thing to do to a degree to get themselves prepared, because like you'd understand in any market, if you're prepared for what's to come on the negative, then usually you can battle that kind of difficult time much easier than having it. The worst thing in the world is when you have to be forced to sell something because you're financially struggling. So they were actually probably being much more responsive than they've ever been, and probably acting in the right way given what was being forecast. It's just unfortunate that the Bureau, it's a probability game, that weather forecasting, particularly when it's out to 3 months into the future. And it was just one of those scenarios where the probabilities were likely for a dry period, but it didn't work out, Yeah,
and it's also too, with cash flows being squeezed dramatically for a lot of producers, you see interest rates triple, essentially the bills that people are paying tripling over a 12-month period, and then plus also the cost of production skyrocketing with inflation. People are naturally going to be nervous. You look down all the research you're getting through, the television, the radio, the BOM market researchers, you could just see how they would have a very pessimistic outlook. In saying that, if it had turned out to be extended and dry, the same thing probably would have been happened, but people would have sort of been justified in taking the action that they had and selling off those cattle.
Absolutely. And you're right too that there were those other overlaying factors, like we'd come off 10 years of really low, uncharacteristically low interest rates. And for those farmers that have been around through previous cycles of high interest rates, thinking back to the late 80s and that as well, that they would have remembered and they would know that those interest rates were not going to stay at those levels forever. So it was a combination of high fertiliser pricing, high labour costs, high increasing interest rates for those that were exposed to debt. Those factors as well, I think, was prompting them to also act quickly. And as you said, if they had have been correct in that assessment with regards to the weather, probably would have been patting ourselves on the back saying, oh, look how great we prepared for this drought and now we're not hurting as much. But it was frustrating when the rain came and we saw all the grass around, and then people had to, kind of go back to increasing their holdings again because they had plenty of feed available.
Yeah. Well, that's the game, isn't it? And if you don't like it, you shouldn't be in it.
That's it. You can benefit or you can lose from the market movements. But look, it's the best thing is always to be prepared and be aware of what's ahead of you so you can probably make the best decisions. And this was a scenario that didn't turn out, but I think it's probably better to be more prepared than to be just sitting waiting for things to happen.
Absolutely. Yeah. And look, the good thing about, I used to talk to people about investing in the share market. As long as you can hold on to your shares when the market turns down, you just ride it through. And again, with a caveat, they're quality shares. Whereas with production, if the price drops and you can hold on to those cattle, who cares? Unless it's dry. And that's the ultimate one, because then you're forced to sell rather than just holding on and riding through those numbers. So, mate, going forward, what's the outlook for the beef prices or livestock prices in general? I mean, let's assume that that's all 100% right, that it was mostly that negative feedback loop coming through. How are we looking going forward when it comes to the fundamentals of the market?
It's pretty positive actually now, Ben, for the next couple of years. And I mean, the only caveat I'll put on that one is that we don't fall back into an extended and strong dry spell or a significant drought, because that will always provide a bit of pressure at price. But when you look more broadly to the global picture, where and this is where I go back to the US again. It's not just an important global economy in its own right, but from a beef market perspective, it's probably the lead market that we would look at as a guide to where things are going. And so the US are they're entering their 50th year of herd liquidation over there, which has meant that their herd numbers are down to, I think, the lowest it's been since the 70s in terms of herd size, and their production's under pressure. Their cold store of meat has been whittled away. So they're relying a lot more now on imported product, and a lot of that comes from Australia or New Zealand and Brazil to a degree. But just in the last month, Brazil has actually maxed out their quota. So Brazilian product's now going to be more expensive going into the US, and it means that in particular Australian product, even though we've seen a recovery in our cattle prices, comparatively we're still very cheap now compared to other global competitors and also compared to the domestic US market. And that's probably going to persist for at least the next 2 to 3 years. So that's going to mean the demand will be there for Australian product. And in the beef space, that's important because 70 to 75% of what Australia produces in terms of beef is exported. And when you look beyond the US, so the reason why the US is so important, Ben, is because they're a key market for Australian product, but also when you look to countries like Japan and South Korea and China, who are the other big markets for Australian beef, the US are one of our biggest competitors in those markets. So if the US are not competitive, it means that our product is getting greater market share. And so the demand in those other markets will also kind of shift towards Australia. So that's going to mean that the Australian market will be supported price-wise into the next few years just because of that global demand and the shortage we're seeing in the US.
It's quite interesting, isn't it? I mean, it'd be nice if the stars aligned the other way for 2 or 3 years, wouldn't it?
Yeah, well, to have high prices and also the strong demand. Yeah, look, sometimes it's one of those things where in a market you can't have everything go your way, but usually you can take some level of a silver lining when you look at what's happening with the fundamentals. And in this case, we did go through a period prior to the correction in the cattle market, at one stage there through like 2021, 2022, when we were in the midst of our very strong rebuild, we had the highest cattle prices in the world, so we were quite uncompetitive, and now we've gone to being quite competitive. So, we were getting some good returns, but it was hard to push the product because of price, whereas now the returns aren't as great, but, the margins aren't as good, but there's a lot of volume. So it's losing a bit of price, but you're gaining the volume. So, you kind of somewhat hedged against that kind of exposure.
Yeah, that makes perfect sense. Now, mate, obviously income's part of the whole solution to running a successful business, but then the other side of the coin is expenses. And the two things that are really pressing on people is interest rates and inflation. So inflation, again, the cost of everything going up. I mean, every month we get the bills come through and we notice they're going up again and again and again. So these are two big topics, but let's just start with inflation. So inflation, again, just for anyone that doesn't know, is just the cost of everything going up year on year. And technically, I think when I was at uni and studied economics, and I'm sure you did, it was the same, as somewhere between 2.5% and 3% was roughly where we expected to be. It's been way over that. Now, I think the government fudges the numbers. That's my personal opinion. I think there's a lot of skullduggery and going on in there, fudging them. But just from a purely technical point of view, how's inflation looking at the moment? And is it actually, let's say, normalizing, or let's say coming back down? And the third point to that one three-part question was, where are we at now? Where's it going? And can we expect it to keep going down?
Yeah, so you're pretty much spot on with what the range is, that the Reserve Bank of Australia is tasked with keeping inflation under control. And so they try and target inflation between 2 to 3% is what their goal is. So obviously, whenever we're below that, they try and stimulate the economy because they're making sure that economic growth continues and you have full employment or close to full employment. And when it's above 3%, inflation above 3%, the way the Reserve Bank acts is to increase interest rates to try and get it back into that target range, which is considered, inflation that's too strong is not good for the economy. And when it's too weak, it's signaling the economy is not strong enough growing. So you've got to have some level of inflation, but just not too much. I think we peaked above 6% in terms of annual inflation last year. And obviously we had a series of interest rate rises to try and combat that inflation. The big problem with this cycle of increases in interest rates is a lot of the reasons why we were seeing high inflation wasn't actually driven by strong demand. It was driven by supply side factors. So if people can recall some of the logistical problems through COVID, some of the kind of getting freight around the world was problematic. There were cost pressures because of things like the Ukrainian war that was causing increases to energy pricing, which was flowing through to increases to fertilizer pricing and other kind of big commodities that drive the global economy. So that was causing issues because of these price hikes were making other companies had to raise their prices themselves to maintain margin. And so the inflation was actually a supply side thing, which was difficult.
Well, interest rates don't really mitigate that, do they?
No, they don't.
It's like hitting a walnut with a sledgehammer.
Exactly, yeah, at the end of the day, there's limited kind of options the Reserve Bank can employ. They have to increase interest rates if inflation is as high as it is. But what can happen is you can continue to have strong inflationary pressure, and the interest rates then add to that as well. And if you're not addressing the underlying supply problems that are causing the inflation, then you can just keep raising interest rates and punishing the growth and demand in the economy. And you can end up what happened in the 70s. And again, it was a similar scenario. We had high prices for energy. There was an oil price problem in the 70s, and it caused a thing called stagflation, which is when you have low economic growth but high inflation, and it's quite a hard thing to get out of.
Would we have that now? Because I've heard the rumours are that we're in a what they call a per capita technical recession. So if that's correct, and I don't know if it is, but that means our economy's shrinking per capita and immigration's keeping that up and inflation's still high, could you argue that that's what we're going through right now?
You're right. It's not a strict recession in the sense that it's not two quarters of negative growth, but when you compare what's happening as in terms of population, it can appear that way. And I don't know if we're quite in stagflation yet. I think that was a risk there. And certainly for a little while there, the bigger concern from an Australian perspective was, I guess, because the Australian economy in the world is a smaller economy when you compare us to the likes of China and the US, and even to the broader European kind of group economy in terms of the Eurozone. They're the economies that really drive global situations. And I think it's, the big concern would be if we saw recessionary impacts in places like China and the US, that would be problematic for Australia much more. And we haven't, there was a bit of fear that the US would enter into a recession, but they haven't so far. They've managed to kind of, work their way through. And it looks like the US have turned the corner. The next move for the US are probably down in interest rates. They have kind of adjusted their forecast a little bit out into the future in terms of when there's a next reduction. But the fact that they got their inflation under control slightly before us, and to get back to your original question, I don't think I answered, our trend has been coming down for inflation. So we're still above 3%. That kind of, we're still above the target range. But I think the chances of another rate rise in Australia, I think, are dissipating. I think the next move will probably be down, but I'm not sure if we'll see it this year. It'll either be late this year or early next year. But yeah, I think we're heading in the right direction, but I don't think it's because of what the government did or necessarily, because certainly the increasing interest rates in Australia have impacted demand, and we're seeing, particularly in the consumer market, there's a lot of struggle there. If you look at some of the indicators there, that the retail side's struggling, and people are mentioning that the interest rates plus all the costs of other added things like, in the agriculture space, like fertiliser or like wages.
And energies, the cost of energy is skyrocketing.
Energy is another big one, absolutely. So I think that has definitely impacted upon the Australian, growth and also the Australian confidence. So I would say we're not in stagflation, but I'd certainly agree it does feel recessionary, even though it's not a strict technical recession. It does feel like the average punter is struggling big time.
One thing I remember, and I'm going back 20-something years, showing my age now, Matt, when I studied Economics 101 and I think 201 and 301 and all those things, one of the things they talked about was neutral interest rates back then. And they said, the way they explained it to me at the time, which totally resonated, it was just really practical. We had this awesome economics professor that I think it was in my third year, that he essentially was a truck driver for many years, and then in his 30s decided to go back and be a professor. So he was the most practical lecturer I ever had. Anyhow, he said to me, Ben, I think it was under 6%, we've got the foot on the accelerator. So in other words, lowering interest rates puts the foot on the economic accelerator. Over 6%, putting the foot on the brake. The higher it goes, the harder the brake goes on. And when you're at 6%, roughly, you're just coasting down the road without the accelerator on or the brake. Now, this is the question nobody's ever been able to answer me since then, is we seem to have this thing of interest rates either need to be going up or coming down. Like it's always, they have to be going up. The next move is not staying. Whereabouts, does anyone give you any guidance, or do you have any idea of where that neutral space would be, where we just let the economy do what the economy's doing? Today's episode is brought to you by AgriCoach. You've worked bloody hard over the years and you've built a solid operation. But as your children grow up and start their own journeys, you're beginning to think about the next 5, 10, and even 15 years and how to keep driving the business forward and ensure a smooth and successful succession plan. Preparing the business, preparing the next generation, and preparing for your eventual retirement all requires a solid plan and a proven process. Unsure about the right steps to take? Head on over to agricoach.com.au/webinar to learn more about our Succession Proof Your Family webinar. AgriCoach, aligning families, growing wealth, and protecting legacies. And now, let's get back to the episode.
Yeah, look, it's interesting he picked 6%. I'd think it was closer to 5 for my liking.
That was a few years ago, Matt. Just put it out there.
Yeah, it could be the case as well that I think if you look at, like, Australia is one of those countries that is quite indebted, and I think we have a higher response to interest rate movements than some others.
Yeah, we're more sensitive.
Absolutely. And part of that's because of the level of leverage. And I think things like, if you look at even, the main thing, going outside of agriculture for a minute, the main borrowing that anyone would do would be obviously to buy a house, and everyone knows, watches the housing market, what's happened to housing prices in Australia in the last few decades. So I think part of that huge growth in the underlying price of housing, and that hasn't really gone hand in hand with the growth in wage rates or salary levels, that, people are having to borrow much, much more than what we used to have to borrow 20 years ago to buy a house and secure it, and maybe have a loan for a lot longer than what would have been the average kind of mortgage length. So I think that's one of the reasons why, as an Australian population broadly, for those that are lucky enough to own a house, I think they are quite sensitive to interest rate rises. That's why I'd suspect, in the last few decades, I think that kind of balanced interest rate level would be closer to that 5% because of that level of sensitivity, I'd say.
Yeah. Okay. Yeah. Well, so my memory might have failed me a little bit too, Matt, because as I said, it was a few years ago. But
it's probably a fair point back. 20 years ago, probably 6% sound about right. But I think
these days it's a lot
lower.
I
would think so. Yeah,
because that's where I think it would be sensible, because then people can work out what they're doing going forward. If interest rates don't fluctuate as much and the government just stays the bloody hell out of it and lets the markets run a little bit, then people can work that out. If I want to borrow and the interest rate's 5%, well, I can work on that. But nowadays people are going, well, it could be 5%, it could be 10%, it could be 2%. There's so much variability there. And for people that are in a very strong financial position, they can then afford to go and leverage and borrow and make more money. But the people that aren't in that stronger financial position are less likely to take the risk, or if they do, they're far more sensitive to the downsides. And this is the thing about inflation, which, I mean, I'm sure you know this, Matt, but for most people I talk to them about is it's just another tax. This is the problem with it, because your purchasing power just keeps going down and down and down over time. And you look at your salary, and I can remember when I started in financial advice in 2000, we were talking to retirees at that stage, Matt, and we were saying, if you had $35,000 a year, you were living a pretty good year. 25, a bit stuffed. Now you're talking $100,000 a year, and you're just sort of back at that, you're probably going to do okay. So that inflation really does have an impact over time. And I think the one I'm worried about is, I can't remember the exact technical terminology. It was like baked in inflation. When inflation just stays around and people just expect it. So rather than it coming back down, people just go, oh, well, that's just what's going to happen each year. And I know I've heard a few economists start to talk about that. Have you heard much about that?
Yeah, I haven't heard the phrase baked in inflation, but I was just trying to think back to when I was studying myself through the economics courses, whether there was an actual strict reference to something like that, but I can't recall one that...
It could be made up, Matt. Maybe I misheard. I could have made it up. We call them Benisms in my house.
Yeah, no. Oh, look, I mean, there's an aspect, it's a kind of ring of truth to it, though, that and it's probably again to do with not so much a market failure, but maybe a reliance on how, like, the economy and the complexities of the economy has changed quite a lot, and things like logistics and transport and getting things around for because it was so much more globalized that, and I think, like I said, COVID was one of those episodes that really showed up how fragile sometimes those links can be in certain circumstances. Having a level of kind of inflationary pressures that are there because of logistical problems or whatever, or that would make some sense. The more complexity an economy is, the more kind of things. It's a bit like an engine. The more complex, the more things can go wrong. So that would probably make sense that there's a bit of stickiness here and there occasionally that can lead to inflationary pressures. But I haven't heard it as an actual economic theory. It might have been a theory after I'd finished my studies.
No, it's probably a made-up Ben theory, Matt. never to be heard of again.
I mean, it's an interesting thought. This kind of idea of an underlying level. I mean, at the end of the day, from an Australian perspective, having that target of the 2 to 3% as a guide, I still think that's kind of reasonable. I wouldn't want to see that level lifted to account for any kind of underlying levels of inflationary pressure. Yeah. So I broadly think that, what those levels are, to me, are still the right kind of targets to aim for. The biggest issue is, like we said before, is around the additional manipulations around market forces that stop the market from working as well as and as efficiently as it could, and in kind of directing resources to the most efficient area. I think markets are very good at doing that. So I always get a bit nervous when governments try to manipulate too much.
Government intervention never works out well if it's too great. I mean, obviously we need a minimum amount of regulation for safety and management of the market, but too much is too hard. What about wages growth inflation? Where are we at for wages growth at the moment, Matt? Do you know the details on that?
Not the exact numbers, but the broad trend I looked at a little while back. It's one of those ones where I look at it because it's not as directly relevant to ag markets these days. It's not one I keep as close an eye on, but I think there has been, because of some of the legacy of COVID, there was a period of time there where obviously the labour market was incredibly tight, and that has eased somewhat. And certainly there are some areas of the economy and industries that are still struggling to find the right people. But I think broadly we're seeing that trend for such tightness we saw through COVID has reduced. But I think there was enough of a pressure there to give wages and wages growth a bit of a kick. So I think it's kind of moving along at a higher level than what it has, say, in the previous decade or so before COVID hit us. But I think it probably hasn't quite kept up completely with cost of living. If you look more broadly, it's probably improved somewhat, and the growth levels of wages to keep up with inflationary pressures have improved. But I think it's still playing catch up if you go back, more than say the last 5 years and go back to say the last 20 years. I'd suspect that we haven't really kept up fully with cost of living pressures as a broad wage indicator.
So do you get the sense we're moving back to a more normalised market now post-COVID and what's going on? I mean, obviously there's the black swan events, the one-offs, we get a war somewhere like in the Panama Canal or something, or the Suez Canal, and next thing trade disrupts, etc. But do you get a sense that things are starting to settle down and normalise with, inflation coming down over in the European and the US markets? Do you feel like that's the case, mate, or do you still see there's a lot of volatility and uncertainty baked into things?
I think we are kind of heading into a much more normal pattern. But I think more broadly, if you look at market movements across commodities and even beyond agriculture, volatility seems to be getting it's becoming more volatile. Markets are becoming much more volatile. That's a bit of a concern for me in terms of, just how much more difficult it makes it for the average kind of person to, one, understand what's driving the volatility, but then also to prepare yourself for, those types of volatile events. And I think, and particularly in the ag space, producers in the ag space, just bring it back to ag briefly and beef more specifically, that concerns me a little bit in terms of, how equipped the average kind of farmer or producer is able to, one, understand what's driving these markets and the added volatility, and then two, having the right kind of tools and knowledge to manage it as effectively as they can. That's a bit of a concern. I don't know necessarily if, from an Australian perspective, if we have all the right tools just yet. We don't have functioning futures markets like they do in America for, say, beef. There's an attempt to get them up and running, but at the moment they're not really liquid and not really working. So, the ability to try and hedge your exposures, so to speak, against certain market factors, whether it's the price you're receiving for your product or the prices you're paying for things like fertilizer or other inputs, that's still quite difficult. It's becomes more difficult the more volatile it gets if you haven't got the ability to kind of to manage those exposures.
Well, it's even like in the US, you buy a home loan in the US or get a home loan in the US, and it's like a 30-year loan. So you're locking your interest rate and off you go. Whereas everything here is there's no fixing or market mechanisms, or very little market mechanisms to be able to smooth out the volatility and those price hikes. So, I mean, that's the tough gig for most business owners these days, is you are totally exposed to the market volatilities, and not only for selling your product, but all the inputs that come in that you have to deal with. I mean, you just look at rural producers, the big ones is fuel, energy, electricity and fuel. You've got spare parts and things like that coming in from your machinery overseas, and plus your commodity prices of your exports. And so it's a highly volatile market.
Add on top of it currency, because like you said there before, a lot of those products are, whether they're chemicals or fuels or parts for machinery. We don't have the manufacturing sector we used to have years ago in Australia. We don't have the fuel refinery. I think we've got one or two left that are being phased out by the end of this decade. So, in terms of refined fuels, we are going to be reliant on imports of fuel and diesel and these kind of things. So, and then if you add on that overlay of potentially more volatility or more conflict, closer to in and around the South China area, potentially into the next decade, it makes life very volatile and very unpredictable. And the fact that we are reliant on imports of some of these key items does worry me a little bit.
Yeah, well, I think from an outsider looking in, you'd almost say the lunatics have escaped and got the keys to the asylum, haven't they? Because we don't produce anything here. We don't have any energy security. We're destroying all our current energy system, transitioning over. So, mate, am I stretching the friendship to ask you a bit about currency?
No, not at all. Happy to.
Yeah, currency, mate. So obviously we're a net importer of a lot of things. We're an exporter of a lot of things, especially in the ag space, as you mentioned. Where's currency at and where's it heading?
Yeah, so we're sitting in the mid-60s at the moment. And it's been actually, considering all the other, volatilities that are around in other markets, the Australian dollar has actually been reasonably stable.
It has. Yeah, I've been really surprised.
Yeah. And when you overlay too, like there have been some concerns around the Chinese economy and obviously being the biggest trade partner. What happens in China very much impacts, and this is outside of agriculture. Of course, they're a huge agricultural trade partner, but they're, as you said before, in the mining space, they're massive as well. So that's kind of a big concern. But, the Chinese economy has been slowing. The growth levels are lower than they're normally used to, and the Chinese government has been trying to stimulate the economy there, not as successfully as probably what they'd like, but it hasn't collapsed yet, which is a good thing. I suspect that it almost could be too big to collapse. I hate using that phrase, saying, "Oh, they're too big to collapse."
Big to fail.
Yeah, because usually it comes unstuck. But the fact they've got such a big population, from an economic perspective, I almost get the feeling that they self-perpetuate, almost like self-motion.
And they're autocratic too. I mean, they can literally do whatever the hell they want, governmental.
Yeah, that helps that you can have a plan of attack that doesn't change for 10 or 15 years with a change of government. So you can kind of have a long-term strategy there that can help as well, or just decide what you're doing and people can't complain. So they have some benefits there, I guess, but I'm not sure if I'd want to live under that system. But yeah, look, from an Australian dollar perspective, I think the fact that China hasn't lurched into a big recession has been helpful, and that's kind of underpinning some of the dips in the Australian dollar. But then you've got this overlay as well of what's happening in the US and the differential between Australian and US interest rates and what's happening with their inflation versus ours and what that means for the spread. That's another thing that drives currency markets to a degree, interest rate differential. And that's kind of keeping the Aussie from rallying too high. So I think that's why we've been trapped in this little bit of a sideways pattern in the mid-60s. Personally, I think it's looking like the US, like I said at the outset, are going to drop interest rates maybe later this year, I think is now the forecast. The original expectation was maybe middle of the year, but some of their inflationary pressures are still not quite going away. If you look at the most recent, it's the FOMC, or the Federal Open Market Committee, is the equivalent of the Australian Reserve Bank. They're the ones that set the US interest rates. They have expressed some concern that inflation isn't getting back down quickly enough, so they're a bit reluctant to drop interest rates just yet. But I suspect that they will get there before the end of the year. So I'm anticipating a drop in interest rates in the US later this year. I'm not sure if that will coincide. I think we're a little bit behind them in terms of our kind of cycle here. And I think that differential widening out in terms of interest rate differential, I think that will probably help support the Aussie a little bit. I should say the interest rate differential narrowing, so that the US interest rates dropping a bit while Australian rates staying a bit higher will probably, I suspect, through this year we'll see the Aussie creep towards the 70 cents. I don't think we're going to go much above the low 70s, by the end of the year, but I think the underlying kind of movement from my mind is that we could see the Aussie just creep a little bit higher. I don't think we're going to see big movements, this year. I think it's been a fairly stable cycle for the currency at the moment.
What are the black swan events, or what things are you watching out for that'll cause us market disruptions, Matt? Because usually there's some things that people watch and have to keep an eye on. What are those, mate, for you at the moment?
Yeah, I think China's one I've already mentioned is one I keep a close eye on just to see how that economy is faring. A few months back, there was the collapse of that large property developer Evergrande. That was huge. Yeah, it was a big concern at the time. But like I said, it appears the Chinese economy at the moment, while it's not growing as fast as it normally does, it hasn't moved into any recessionary kind of stage. So I think that's one I'm watching closely to see how that kind of plays out. And the other thing would be just the two, I guess, big conflicts at the moment with Ukraine and in Israel and Gaza. They're obviously the potential for that conflict area to expand potentially is worrying, and the overlay on that would be obviously the election in the US.
Yeah, that was the one I'm watching, because I think that's end of this year. That's going to be very interesting to watch.
Yeah, it will be. I suspect that we'll see another Trump presidency.
So do I.
And when you take into account, like last time he was in power, we didn't have these two significant conflicts, and the nature of the way. I mean, Trump is very much a wild card when it comes to his political behaviours. He's a bit hard to predict which way he's going to go. So I think that's probably that's something I'll be watching closely. But it's one of those things where if and when he wins power, and then we'll be back in for some potentially much more volatile times. Yeah, who knows what he's planning, to pull out of the hat this time around.
Yeah, it's an interesting one, isn't it? Because I think that's the one to watch, because the paradox of it is he is so unpredictable, and he's a bit of a firebrand and a firecracker, and you don't know which way he's going to go. But when you look back to his time as the president, the economy was strong. There were no wars around the world. It was a very stable period economically versus what has been over the last 4 years. So it'll be interesting to see whether if he does get in, becomes a stabilizing source or a destabilizing source. And I think if I put a bet each way, I can't see a clear path of which way it'll go.
Yeah, I mean, I agree with you that I think given the level of his unpredictability and the fact that he's not a traditional political person, so to speak, that others within that space internationally just don't know how to read him, and therefore they kind of quieten down their own behaviours because they're not sure what he's going to do. That potentially makes, like you said, for more stability. We even saw the likes of Kim Jong-il, kind of engaging because, there might have been fear around unpredictable behaviours, so it kind of pulls them in line a little bit. But it will be interesting to see. From an Australian perspective, though, the other concern I do have with the Trump president is, if we recall when he got in last time around, there was all of that saber rattling towards China about trade, and then there was a bit of a kind of
backlash.
Well, there was a period where where he was kind of railing against China, but then they managed to organise a trade deal through his term, right, which included agricultural products, if you remember. And so part of then, in some parts of the Australian agricultural sector, like beef, wine, barley, lobster fishes, like all of those trade issues we had across, and timber, I think, was also included for a while there. Some of those sectors that got targeted by China from Australia, part of what was also driving some of that was the fact that the Chinese had to do trade with America in a lot of these commodities instead. And particularly if you take it back to the beef space, through that period of 2019 to 2021, when that trade deal was in place, the US actually got a foothold into China for their beef exports. Whereas prior to that, they were about 1% of imports coming into China was US beef, and they got to about 12% after the trade deal. And the country that was most disadvantaged out of that was Australia. We had issues with 8 abattoirs, and so our beef levels, they didn't completely go, but they certainly were much lower. Part of it was price, because we were uncompetitive on price, but also part of it was that the Chinese were having to make good on that trade deal, and so they were happy to switch away from Australia for certain goods and go to the US to replace those goods, so they could kind of make good on the trade deal. So, yeah, hopefully, Trump presidency, we don't see a reversion back to, Australia being put into the sin bin again for some of these commodities, because we are so reliant on countries like China for some key goods.
Yeah, we don't have the economic power to be able to demand what we want.
Exactly. Yeah, well, I mean, we looked at that when that deal was announced. We analysed the key markets we felt that were most exposed, and we created a list of about 10 agricultural commodities and said these are the potential ones that could be problematic for Australia. And I think it ended up being 6 or 7 out of the 10 that we listed were actually targeted in the end. And it was purely because they were also commodities that the Chinese could switch out of and take from the US instead. So, yeah, hopefully we're kind of past that point, and our diplomatic relations with China now are strong enough to not have us be put back in the, like I said, in the sin bin for a while, because that was incredibly damaging for some sectors of the economy here in terms of agriculture.
Absolutely, absolutely. Now, Matt, you've got a podcast yourself, mate, Ag Watchers. Tell us all about that.
So my business partner, Andrew Whitelaw, and I, we work at Episode 3 as our day job, which is analysing all range of markets, like you said at the outset. And so part of that role, we get to speak with and engage with the whole heap of different people across the agricultural sector, people in policy, politicians, business leaders, in key kind of, agricultural companies. And we've found through the years that being able to, when you go to a conference and have a chinwag with new people, we were having these really fascinating, great conversations with really switched on people. And we just thought, look, why don't we have these conversations occasionally and record them? Not as professionally as you do, Ben.
I don't know about that.
Ours is a little bit more of a hobby podcast that that we do, just because, look, we like chatting about markets. We both have the same kind of passion. Andrew and myself have a passion for markets and all things market related. So, yeah, we have a podcast that's usually once a week. We do a bit of an interview with someone from the sector or involved in some capacity within the sector. Like I said, they're not always a producer necessarily. They could be a consumer of an item, or they could be someone in the policy space, or a politician, or just even someone in the research and development area where there's been a new thing happening in their particular part of whatever they're kind of participating in the ag space. So we get them in to have a chinwag about what's happening, and that's something we do for a bit of fun. And it's always good to be able to have these discussions with people that are more knowledgeable than us, so that we learn, and hopefully the listener learns as well as we're going along. But it's fairly laid back, like I said, and a little bit sometimes a little bit cheeky in terms of how there's a few in jokes and a little bit of gentle. Andrew and myself have a little bit of a rib at each other occasionally. So we try and make it engaging and enjoyable as well as entertaining.
Yeah, well, markets can be pretty dry.
That's it. No, so yeah, bringing in the odd reference to something and getting a bit silly occasionally can help, ease the pain when it comes to talking about dry things like interest rates and inflation and the tough stuff in life. When the markets are turning bad, you got to still try and have a positive outlook, I think.
Absolutely. Yeah. Well, look, the thing that I've taken away from you today is the fact that the beef prices look fairly optimistic over the next 2 to 3 years, which is great. I'm sure most producers will be very, very happy to hear that. I totally get the fact that there could be black swan events or things outside our control, just like with the weather, but that's a great message to go through. I mean, we talked about a whole lot of negative things at the end, but we need to be aware of those. But the future looks bright, which I love to hear. So, mate, I've really enjoyed today. This is an area that I like. And the question I want to ask you, Matt, before we head off, is if you could go back to, say, when you're in your 20s, mate, and I like to ask everyone this because it's interesting the answers that come out. So if you could go back and you could get in your time machine and you zoom back and you meet up with young Matt, say 25-year-old, what's one piece of advice you give him?
It's an interesting one, that one, the old travel back in time. And would you do is the question geared around would I do things, or would I say do this different, do that different in specific events, or
mate, I don't care. I don't care what it is. You go back there, you've got 5 minutes with young Matt and you've got to give him some advice that will benefit you in the future. Yeah.
So this is, from my perspective, I've always thought, don't get me wrong, I've made plenty of mistakes on the way through, but I'm a strong believer in that when you make mistakes or you go down the wrong pathway for a little bit and you learn that lesson, it's crucial to who you become, right? So to go and give advice and say, don't do this, don't do that, the risk there would be that the Matt becomes a different person to who I am now,
Sliding doors.
Yeah, so I'd be reticent to say don't do certain things that weren't the best ideas just because I wouldn't have learnt a key lesson, right? So probably what I would say, I'd still want to give some level of advice, but I think what I'd say would be just trust your instincts and don't worry if you make an error as long as you make sure you learn from it. That's probably what I'd do. I wouldn't drill down on one particular event or one particular thing. That's what I'd say. Just kind of have confidence in what you think and keep that confidence going. Try and stay positive.
Yeah, I think that's some great advice, mate. And look, it's a common theme. Couple of things comes through is back yourself. So in other words, back up what you're going to do, take the risk, and also failure in inverted commas is perfectly okay. That's how we learn. Failure is just feedback, and as long as you take the lesson from it and move forward, it's been a good thing.
Absolutely.
Awesome, mate. Well, look, I love what you do. Love the podcast. Love the fact that you're as nerdy about these things as me. You do it for a full-time job. I just do it out of interest from the side, and I appreciate it. Is there one last thing you want to give the audience, a bit of advice or anything before we leave?
I think as much as, I love markets and love being prepared for all those kind of market-related factors, I think, a crucial thing for that ag space and that ag audience is all around increasingly around self-care. And I think, markets are one thing, but I think you've got to be always conscious of what you're doing on farm in terms of safety, making sure that you're not getting too sucked into always, just because a lot of these farmers live on farm, and that's home as well as the farm and business. Making sure you've got time for yourself and to your family, is important, and making sure you're looking after your mental health if you need it. I think some of those things are absolutely crucial, and God forbid, sometimes even more important than what's happening in the market space. So I think anyone listening, just make sure that you've got a good foundation and that you're keeping up to date with all those things too that are crucial, that are non-market factors.
Yeah, love it, mate. You can't control the markets, but you can control the way you react to them.
Absolutely.
Perfect. Right, Matt, mate, you're a busy man. I'll let you get back to the rest of the day.
Cheers.
Thanks very much for your time.
Thanks, Ben.
Well, that was a lot of information to digest. Something that I love doing is talking about markets and the economy, etc. I think the more we educate ourselves in these areas, the more we can understand how they coexist or co-interact and the impacts that they can have on our business. What I want you to take away, which I said right there at the end, is from what Matt says, with all the information to hand, the outlook for beef prices and prices in general look fairly optimistic. Obviously, there can be some black swan events or things that change, and the same thing from an inflation and an interest rate point of view. I've got an economist coming on in the next couple of weeks that we're going to dig into interest rates again. It'll be good to get someone else's point of view on this, but I want you to take away that positive message. Now, as I said in the beginning, we love doing the podcast. It's being shared far and wide by many of you, and I just want to say thank you. But for any of you that haven't done this before, if you enjoy what we do, the best way you can support us is to go onto Apple Podcasts or Spotify and leave a review, and also go tell your friends about the podcast. Every episode has something different. We're an education podcast, so we're trying to help everyone increase their wealth and also their wisdom at the same time. Now, that's it for today. We'll see you for the next one.